Welcome to the Deep Dive, where we cut through the noise to bring you the sharpest insights. Today, we're dissecting Mohawk Industries' Q2 2025 earnings call. The headline seems to be a beat on earnings, but, underlying challenges definitely persist. The big question for us and for you listening is, are Mohawk strategic plays truly building resilience for long-term growth? Or are investors maybe just seeing what they want to see in, well, a pretty choppy market? Let's dive right into the headlines then. Mohawk beat expectations.
Yeah, but the real story here isn't just the numbers themselves, it feels like. It's more about the strategic flex, right? Despite those margin pressures, they're generating serious cash, and they're deploying it aggressively. I mean, that's a confident move in what seems like a tough market.
Exactly. Yeah, Mohawk Industries reported adjusted earnings per share of $2.77 for Q2. That comfortably beat the consensus estimate, which was around $2.62, maybe $2.63. Revenue came in at $2.8 billion, so also a slight beat there. But, like you said, the strong free cash flow, approximately $126 million, and that massive new $500 million share buyback authorization, that's on top of the $42 million they already executed. It really signals management's conviction. It tells us they're not just treading water. They're strategically investing in shareholder returns, even as the market turns.
Yeah, that proactive capital allocation, even with that dip in margins, it certainly caught the market's attention. It suggests investors are perhaps looking past the immediate challenges. Okay, let's unpack these numbers a bit more. That margin compression really jumps out at me, especially alongside the EPS beat. Is that, a sign they're truly feeling the squeeze, or is management maybe intentionally sacrificing some short-term margin for longer-term positioning? What's your read?
That's a good question. I think it's probably a bit of both. The decrease in both adjusted EBITDA down to 13.3% margin and the operating margins, 8.0%. That was primarily attributed to some undeniable cost headwinds. You had higher input costs, lower sales volume, and increased plant shutdown costs. And these were substantial hits. They largely offset some pretty impressive productivity gains and favorable foreign exchange effects. However, what's noteworthy is how they're fighting back, right? Those restructuring benefits they talked about, they aren't just cutting fat. It feels like they're strategically repositioning the entire cost base for the long haul.
Right, so rising costs were a major theme, clearly. And like you said, they're not just sitting idle. How exactly is Mohawk tackling these persistent challenges, especially with an eye on the future?
Well, management highlighted two key strategic initiatives. First, major restructuring efforts are well underway. They're targeting $100 million in benefits for 2025. This involves things like closing high-cost operations, getting rid of inefficient assets, streamlining distribution, and leveraging technology across the board, admin, operations, everything. Second, their global operations team is continuously identifying productivity initiatives. Think equipment enhancements, energy conservation, supply chain optimization, all designed to lower costs further and just make operations more efficient.
Okay, and speaking of global dynamics, tariffs are always a huge wild card in the sector. How is Mohawk playing that hand, especially given their extensive manufacturing footprint?
Yeah, this is a really crucial area and one where Mohawk actually sees a potential competitive advantage. Get this, approximately 85% of their U.S. sales are from North American-made goods. So this local production emphasis, it positions them pretty favorably amidst all the evolving U.S. tariff policies. They actually view it as a potential tailwind. They're actively monitoring negotiations, of course. There's a U.S. government deadline of August 1st coming up, and they seem prepared to adjust pricing and supply chains as needed. They also noted, interestingly, that the impact of any new tariffs on current year results would likely be minimal just due to timing.
Okay, so that covers their internal actions and the tariff landscape. What about the broader market? What did Mohawk say about conditions in, say, residential versus commercial, and the macro trends impacting the business?
Well, management characterized the overall industry as facing, and I quote, challenging conditions. This seems driven by consumers putting off large discretionary purchases for, nearly 3 years now. Residential demand remains soft. It's a confluence of factors. Geopolitical events, persistent inflation, really low housing turnover, and of course, high interest rates. In fact, they mentioned U.S. housing inventory is currently at its highest level since 2007.
Wow, since 2007.
Yeah. However, the commercial sector seems to be a brighter spot. It's generally outperforming residential. They mentioned strong backlogs in areas like education and hospitality, although there's a little caution there too. The Architectural Billing Index, the ABI, forecasts a potential slowdown even in commercial down the road.
So very mixed bag across their end markets then.
Pretty much, yeah.
We also heard some important updates on interest rates globally, right? which could certainly influence consumer spending and that residential demand picture.
Absolutely. So, while the Federal Reserve here has postponed interest rate cuts for now, most forecasters still believe we'll see probably 2 cuts in the second half of 2025. Meanwhile, over in Europe, the ECB actually cut rates to 2% back in June, trying to stimulate the economy. And that coincided with Germany approving legislation to expand home construction. What's also got kind of fascinating over there is that European households have apparently accumulated record savings since the pandemic. So you combine that with potentially lower rates, it could fuel future spending and housing sales. Definitely something to watch.
Okay, so beyond the broad strokes, what's happening, in the trenches? How did Mohawk's individual segments actually navigate these difficult conditions in Q2?
All right, getting specific. In global ceramics, sales actually saw a slight increase. That benefited from their push into premium products, strong commercial projects, and also expanded distribution. For Flooring North America, they saw pretty robust performance in hard surface categories. Think LVT and laminate. That helped offset weaker carpet sales, which continue to be a drag. And for Floor and Rest of the World, they seem to be managing difficult conditions through operational enhancements. They saw improved laminate performance. They're expanding LVT distribution, although their panels business that faced significant pressure over there.
Okay, makes sense. So looking forward then, what guidance did Mohawk actually provide? What's their outlook for the rest of the year?
All right, guidance. For Q3 2025, Mohawk set adjusted EPS guidance between $2.56 and $2.66. Now, that excludes restructuring or other one-time charges, but it is notably below the prior street consensus, which was hovering around $2.70. Management basically said they expect these challenging market conditions to persist right through the second half of the year. They don't see any immediate improvement in mortgage rates or inflation or, crucially, consumer confidence.
That does sound pretty cautious for Q3, but do they offer any glimmers of hope, any inflection point beyond that?
They certainly did, yeah. They definitely tried to take a longer view. Mohawk anticipates that input cost pressures will likely peak in Q3, and then they should start to ease in Q4 as some of that higher cost inventory flows through the system. So you combine that with the ongoing restructuring benefits, the productivity gains they're finding, maybe some price increases, and a stronger product and channel mix. All that together is expected to lead to an improvement in Q4 results year over year. They also threw in an interesting comment about seasonality. Normally, sales decrease maybe 5-6% from Q3 to Q4, and EBIT can drop over 25% because of holidays and shutdowns. But they think the restructuring benefits should actually make this year's Q4 better than that historical seasonality suggests.
Ah, interesting.
So yeah, challenging Q3 ahead, it seems, but a more optimistic Q4 and definitely a clear long-term view they're trying to paint.
Okay, so what does this all mean for you, our listener? It's interesting, right? Despite that lower Q3 guidance, the market reacted, well, positively. I'm genuinely curious here. When you see that kind of positive market reaction despite cautious guidance, what's your first instinct? Is it just smart money looking way ahead, or maybe a bit of wishful thinking baked in?
Yeah, it's fascinating, isn't it? Investors are clearly looking beyond the immediate headwinds here, that strong free cash flow generation we mentioned, and especially that new substantial $500 million share repurchase authorization. That really signals management's confidence, right? And their commitment to shareholder returns. It's kind of a classic case, management using those transactional levers, the buybacks, to provide some EPS ballast. It effectively puts a floor under earnings by reducing the outstanding share count during a soft market patch. You combine that with $100 million in restructuring benefits that seem on track for 2025. It really suggests a long-term focus on improving the P&L, the per-share outcomes, even if the end markets stay kind of tepid for now.
Okay, so the market's looking past the immediate hurdles, focusing on this re-rate potential. You mentioned essentially the market reevaluating the company at maybe a higher multiple down the line. But is there a risk of, over-optimism here? What if those macro conditions don't improve as quickly as people hope? Or what if this tariff moat, as you called it, proves maybe shallower than anticipated?
That's the crucial question, absolutely. And it's really where the catalysts come into play. Investors are basically betting on execution, especially on those restructuring savings actually hitting the bottom line and on the buybacks continuing. The emphasis on locally produced collections, those supply chain adjustments, it should provide a competitive advantage in this evolving tariff landscape. It's all about preparing them for that re-rate moment when macro conditions eventually do improve. Key things to watch. Definitely Q3 performance against that revised guidance, getting clarity on those tariff decisions. Also, the pace and scale of the new buyback program. Are they actually deploying that cash? And fundamentally, are those restructuring savings really flowing through as promised? But you're spot on. A prolonged residential downturn remains the key risk. that could derail even the best laid plans.
All right, it's time now for our This Is Not Financial Advice segment. This is where we pitch an outrageous but maybe plausible trade idea, just like, a hedge fund analyst might to an investment committee. What have you got for us today? Okay, given everything we've just discussed, here's an idea for consideration. Go long Mohawk Industries, ticker MHK. The thesis is built on, essentially, its undervalued domestic production advantage, especially amid escalating global trade tariffs. Combine that with this aggressive share buyback program that's creating an EPS floor, even while we're sitting at cyclical housing lows.
Okay, tell us more. Unpack that rationale. What's the core conviction behind going long right now?
Okay, the core rationale is this. Mohawk's 85% North American production figure. It isn't just a talking point. It's a significant and, I think, underappreciated tariff moat. As global tariffs continue to potentially increase costs for importers, Mohawk's domestically produced goods just become relatively more competitive. That provides a pretty significant tailwind, potentially, when the market eventually normalizes. Now, yes, current market demand is soft, we know that. But the company is not just sitting idle, right? They're deploying strong free cash flow into this aggressive new $500 million share repurchase authorization. That acts as an EPS ballast, like we said. It effectively puts a floor under earnings during this, let's call it, repair phase of the cycle. So this isn't just about weathering the storm. It's positioning for a potentially powerful re-rate when rates inevitably turn, and maybe tariffs bite competitors harder. You could think of it as maybe a value play hiding in plain sight, sort of engineered for a post-tariff, post-cyclical boom.
Interesting. And what are the key catalysts you'd specifically highlight for this trade? What needs to happen for this long thesis to play out?
Key catalysts. First, strong Q4 actual results that really do outperform that historical seasonality, proving the restructuring is working. Second, the finalization and, importantly, enforcement of new tariffs that specifically drive up competitor costs, validating that tariff moat idea. Third, sustained deployment of free cash flow into accelerated buybacks, showing commitment to that EPS floor. Of course, the main risk remains, as we discussed, a really prolonged residential downturn, or maybe aggressive competitive pricing that somehow defies the economics of tariffs, which does raise an important question, right? Can their domestic advantage truly shield them if the overall market weakness persists for longer than expected?
Definitely food for thought. Okay, that's a wrap on our deep dive into Mohawk Industries' latest earnings. It seems pretty clear management is actively navigating a challenging environment with a clear strategy, focusing on cost containment, strategic capital allocation, and really leveraging that domestic manufacturing strength for the long term.
Indeed. While the immediate outlook, particularly Q3, presents some hurdles, the market's reaction and management's narrative definitely suggest a company trying hard to position itself for that re-rate as economic conditions hopefully eventually improve. It's definitely one to keep an eye on just to see how those strategic plays actually unfold in the coming quarters.
And as we wrap up, here's something to consider. Mohawk's strategy is a clear bet on domestic production and a future tariff landscape playing to their strengths. But is it possible that the biggest re-rate catalyst, or perhaps risk, won't come from tariffs or interest rates at all, but maybe from a deeper, unaddressed shift in consumer behavior, something that even those record European savings can't quite overcome? Just a thought to leave you with. Thank you for joining us on the deep dive. We hope this analysis challenges your perspective and gives you a new lens through which to view these earnings calls. We'll be back soon with another deep dive to keep you well informed.